All right, great. Well, thanks everyone. Like I said, thanks for dialing in. Appreciate your time. Appreciate you always listening to us. Got 7 slides, as I mentioned. What I want to do is just start like taking a slight look back. Let's look back over the prior 5 years. As David was talking about, clearly 2020, I think is still pretty fresh in our memory. It's been 4 years now. It's hard to believe, but if you remember back what it felt like in 2020, markets started to go into free fall. They were down 32% in a very short period of time. And I remember how that felt. I'm sure you do as well. And it really felt pretty traumatic at the time. Although if you were dialing into any of the web conferences that I had done at that time or speaking to David, I'm sure we were talking to you about the fact that we felt pretty confident that we had a very strong portfolio. We thought we had great companies with great balance sheets, and that even though we didn't know how long the storm would last, that we were pretty confident we could make it through the storm and also potentially end up even better than where we started. More importantly, I think, if you look back over the course of just this 4.5 years, in just a short period of time, just look in relative terms, or really in absolute terms, I guess you could say, in terms of that drop. That drop felt so big when it happened. But if you look back over the past 4.5 years, you can see it's a little bit more than a big bump in the road into an otherwise, largely moving pattern. And that's really the case with markets. If we can stand aside from the moment, kind of fight the urge to be concerned and to go to cash and to really react to what's an otherwise quick moving situation, over time, if you let the market do what it does best, it eventually will come back, especially when you're talking about the S&P 500, which has 500 companies, not just one particular company or stock. It'll come back to flat and then again go higher at some point. It may not always happen as quickly as this, but the bottom line is that if you can stick with the market over longer periods of time, as markets recover, as the indices move higher, you'll continue to see that you'll not only get back to where you started, but keep it moving higher. And those really, really big drops at the time will feel smaller in hindsight. And that's definitely a lesson that's worth considering, because we've had a pretty good run. We want to make sure that, as we go into the future, we will have future drops, of course. And so just being aware of the context and thinking about the fact that, those drops in the market are just a part of being in the equity markets in general as an investor. So on this next slide, I'm going to take us back to 2022. So if you see this is a list of the 6 categories that the National Bureau of Economic Research uses in order to determine whether or not we're in recession. This chart I present at the end of 2022. And so what I had said at the time, and I'll reiterate now, is, you can look back to March and April of 2020. It's red across the board. You can really see that we absolutely were in recession at that time. And so the colors in the chart for those 6 indicators are really talking about red is a severe contraction, green is an expansion, and then there's shades of green or yellow or orange in between, either showing slightly growing or slightly contracting. And you can see that over time, various indicators flash red. And actually, if you look at February of 2021, there was quite a few. But at no point in time between the end of April 2020 and the present have we seen red across the board. And sure enough, there haven't been any recessions declared in the past 4 years, or really since April of 2020. And yet you'll remember in 2022, that was a really bad year for the stock market. The stock market went down pretty precipitously, not as much as in 2020, but it was down close to 20%. Stock market went down, bond market went down. And the point is that, stock markets can go up or down regardless of whether we're in a recession. Typically, you'll see markets go down farther and stay down for longer when we're in a recession. But if we're not in a recession, there's definitely some cause for optimism. And that was really what I was talking about back in 2022, which was, despite the fact that we'd had a relatively bad year in the market, again, it made sense to at least stay the course, potentially be a little bit more optimistic for the future. And, really that's kind of what happened. We saw a bottom at the end of 2022, and the markets have been going up ever since. Moving on to the next slide, this one's on inflation. And unfortunately, for the last 4 years, I haven't been able to get through a single presentation without talking about inflation. And that's because inflation has really been driving everything that we've seen in stock and bond markets, or at least the reaction to inflation over these past few years. And so just as a reminder, inflation is actually the rate of change. So we all know that prices on average are about 33% higher than they were at the end of 2019. Some things have doubled or tripled. Other things are probably only up by single digits. If you can find me something that went down, I'd love to see it. I'm not really sure of anything off the top of my head. But on average, things are up about 33% since the end of 2019. There's really nothing we can do about that. It's very unlikely that we're going to go back to the price levels of 2019. But what has changed is the rate of inflation, the rate of change year over year, which had been in a range of somewhere between 0 and 2% ever since the financial crisis, and had been relatively stable for around 30 years. If you go back to the early 90s, really not jumping much above 3 or 4%. You can see that things were relatively contained. Now, as we all know, after the pandemic, there were supply chain issues. There was a lot of monetary and fiscal stimulus by the federal government. By some measures, maybe a third as much of our overall economy in terms of size in stimulus. And as we all remember, back in the summer of 2022, inflation peaked. The headline CPI was 9%. So that was prices growing 9% year over year. Now, fortunately, that number has come back down. We're now more in the 2 to 3% range. Again, rate of change, not price level. And so, that's a good thing as far as the Federal Reserve is concerned, and as far as really economists and market strategists are concerned. So again, despite the fact that the price level has been reset at a higher level and it's unlikely to come back down, that rate of change has slowed, and that is good news for all of us as investors and even as consumers. So, I mentioned the reaction to inflation being a big deal. And as I'm sure you remember, the Fed started raising rates a couple of years ago. And you can see by this graph, the Fed funds level, the level that the Federal Reserve keeps as the base interest rate for all banks in terms of interbank transactions, had got cut close to zero during the COVID pandemic. They were a little bit slow to diagnose the inflation problem. They originally thought it was a transitory issue, one that they didn't need to take action to combat. And then they quickly realized that they had made a mistake and that inflation was continuing to go higher and was something that they needed to take action on. So, as you can see in that chart, they started raising rates pretty rapidly. And over a very short period of time, they got up to a range of between 5.25% to 5.5%, which is where we are today. And they've kept that steady for really a little bit over a year. They stopped in July of last year, and here we are in August heading into September, and things are about to change. And so the good news, as David alluded to in his opening remarks, is that the Federal Reserve is now ready to start cutting interest rates. Now, whether they cut interest rates by 0.25% or 0.5% next month, that still hasn't been determined. My expectation, and I think David shares this, our expectation is that they're going to cut rates by 0.25% next month. And then I think they'll likely go at the same pace over the next couple meetings. So our expectations in terms of kind of a base case is 0.25% reduction in rates next month. Then they'll do the same thing again in November, and they'll do it one last time in December. But that's all subject to change. If between now and September we start to see the unemployment rate spike up, or you see the economy slow materially, they may move more quickly than that. They may cut rates by even more than 0.25%, and they may cut rates more quickly. And conversely, if you see inflation kind of get stuck, or you see it start to go back higher, they absolutely could slow the rate of the pace at which they're cutting rates, or even pause their rate cuts entirely. So why do we care about what the Federal Reserve is doing in interest rates? Well, not only in terms of setting stock and bond prices by the overall interest rates, as well as being one of the key rates that eventually settles back into mortgage rates, car loans, credit card loans, et cetera. It's also historically been good for the stock market when the Fed stops raising rates. And so this is a chart that I actually showed in Charlotte the beginning of this year in February. And so if you can see in this chart, it really shows the last 6 or 7 bull markets. It shows that at time zero, that dotted line on the kind of the left side of the graph is where the Fed stopped raising interest rates. And then what did the stock market do after that? And so for the most part, we've seen a pretty good story of a rebounding stock market, one that's gone higher. Now, there is one exception to that rule on this chart. That's the dot-com boom and bust. And you could argue that was a pretty unusual case. But in general, once the Fed is done raising interest rates, that typically can set a base or a bottom for the stock market. And you can see markets starting to go higher. So on this chart, that red line shows the bull market that we're currently in. Back in January, when this data came out, which was right before the February meeting that David and I hosted, there had been about 6 months since the end of July 2023, since the Fed had stopped raising interest rates, and markets had gone up, let's call it somewhere in that 6 to 7%, kind of mid-single digits range. If you fast forward to where we are today, call it 12 or 13 months past the rate hiking cycle, we at one point hit a little bit above 20%. So not 20% year to date, but 20% since the Fed stopped raising interest rates last year. And so you're really starting to see the pattern, if we extended this line, similar to a lot of the other bull markets. Again, past performance is indicative of future results and all of the typical disclaimers. And clearly every single market cycle is different. And this has been an unusual one. But if you can use history as a guide, there is some cause for optimism that not only what we've seen so far falls in line with most of recent history, but that typically when things have gone that path so far, they continue to do well. Again, no guarantee for the future, but another reason for us to be optimistic heading into the fall. So, but with that said, again, I'd like to just kind of take another step back. Instead of pulling back 5 years, let's look back over the past 45 years. And I think this chart is important. It's the second to last chart that I'm going to show you today. And it really shows just the annual return. So in gray, you're seeing either positive or negative returns calendar year across the last 45 years. And you can see in most years, the stock market is positive. That's something that we know. There are a number of notable exceptions. You can look back to 2000 to 2002. You can look at 2008. Of course, remember 2020. So there are many examples of when the stock market has been lower. But what I think we don't typically think about in terms of the stock market is not just the final return for the year, but what happened in the middle of the year. And those red dots show all the different times the stock market went down in the middle of any of one of those calendar years and how far it dropped from peak to trough. So you can see in many cases, it'll drop by 10% or more. There's a lot of examples of 17%, 18%, 13%, et cetera. Plenty of examples of where the stock market will drop by double digits, 10% or more. On average, that happens every 2 years. We haven't seen it recently in the last couple of years, so I'm not going to say the pattern will always unfold the same way. But what I will say is that if we were to drop by 10% or more in the middle of this year, it's not something that would really surprise me. I'm sure the reason that begins the drop could be surprising, but it is very normal in stock markets for them to drop in the middle of the year. What I would say is that if it drops in the middle of the year, that in and of itself isn't necessarily a warning sign. For the most part, when you see the market dropping in the middle of the year, it will often recover and return positive. Again, the main exceptions to when the market will drop in the middle of the year and stay negative for the year is when we enter a recession. Right now, it doesn't look like we're entering a recession. We are seeing a little bit of a growth slowdown. We are seeing the unemployment rate tick up. But I would say any volatility that we see between now and year end, you have to watch. You have to kind of take a look at what's happening and why and see if anything is changing. But just to be prepared, I think it makes sense that despite the fact that we've had a pretty big run in the last 2 years, that we just want to be ready. We want to be prepared for when and if we can see some of those pullbacks and just be aware that it's normal. It's something that happens all the time. None of us really like volatility, don't like the way it feels. It's similar to how I feel on an airplane when there's turbulence. I don't love it. I don't think there's many people who really like it, but it just goes with the territory, and it's just something that we need to think about. Obviously, everyone has their own portfolio, maybe a little bit different, slightly different exposure to the stock market versus the bond market. You all have had individual conversations with David, and I would encourage you to keep doing that in terms of thinking about, what's the right amount of volatility for yourself personally, and also what's the trade-off between having less volatility and potentially having higher returns. We all have a different trade-off in terms of what type of returns we're looking for over the long term in terms of our portfolio, and also how much volatility we're willing to bear in order to get there. And that's something that's not unique to this moment in time. That's always been the case, but again, kind of worth remembering. So with that, let's move on to our last slide. And again, because it is an election year, unfortunately, I think I just have to end on a political slide. I don't really love talking about politics. I don't know that David does either, but it's a fact of life. We all feel passionately about what's happening within the political parties, within the country. Clearly, even on this call, there's going to be people who are going to feel differently, maybe potentially in completely opposite directions in terms of who you would like to be running for president, let alone who you would like to actually become president. What I think is important is not just to avoid the topic of politics or just to put our head in the sand or pretend that it doesn't affect us. It absolutely does. And I thought this chart was really interesting. It's a good reminder for myself. I hope you'll also find it interesting. But, if you can look, not only does, what happens in terms of who wins the presidency or wins various elections, whether that's Republican or Democrat, excuse me, that impacts how you feel about the economy. I'm sure it impacts how you feel about the stock market. It may even impact on what you think our future prospects are. And so it's just really important to recognize that regardless of what the outcome is this November, first of all, the companies in our portfolios are pretty nimble and pretty versatile, and they've been adapting for decades, if not longer, in terms of some companies that have been running for 100 years, and they understand how to navigate the various political environments. Regardless of who's elected, Republican or Democrat, the companies that we're invested in will find a way to adapt to the circumstances, whether that's higher tax rates or lower tax rates, higher regulation or lower regulation, trade wars, not trade wars, et cetera. Ultimately, those companies will adapt and will be able to succeed. And I have other charts which will show you that over longer periods of time, companies really can outperform both in Democratic as well as Republican administrations, and really within mixed Congresses and mixed political environments. At the end of the day, it doesn't matter as much necessarily who wins for a longer period of time. What matters is that the certainty happens. So typically before an election, you'll see a little bit more volatility, maybe a little bit more uncertainty in markets. Clearly the markets are moving, trying to anticipate who will win, what are the implications potentially on a sector or company basis. But at the end of the day, once the election is over, typically the stock market will go higher. It doesn't happen every time, but it will often happen. And that's not because the market is happy about who won. It's just that the market knows who won. So it's that uncertainty prior to the election that typically will give the market jitters. And so that's something to be aware of and to be not necessarily alarmed at if we see some volatility between now and November, but to understand just getting through that event's important. So, all right, so I'm not really seeing any questions in the chat or hearing anyone open up the lines. I don't know, David, is there any questions that you've been getting recently that are worth addressing, or should we shut down the call and just let everyone reach out to you or anyone on the team if they'd prefer to ask their questions in private?
Yeah, I think one question I get, and this is pretty fairly regular, is, based on the fact that the market has been pretty strong, Chris, since basically October of 2022, we've been on a nice rally. Do you still think that it makes sense to dollar cost average on new investment monies, or does it make sense at this time to go ahead and just put in? I know that's a little bit of a leading question. Certainly, nobody ever wants to miss out on an opportunity. So I think I know where you'll go with this, but I figured I'd let everyone hear it from you.
Yeah, no, that's a great question. It's one that I get a lot, and I'm glad you asked it. Yeah, I mean, in general, I'm a pretty big fan of dollar cost averaging because I think you just really never know day to day or week to week where the market's going to go. Generally speaking, what I like to do is if valuations on average are very low historically or lower than in the recent past, I would more front load or potentially get away from dollar cost averaging. So that would mean if you had, $100,000 of new money to put into the market, if valuations were relatively low, I might be inclined to put in, $50,000 or maybe the whole $100,000 in right away. If valuations were relatively low or extremely low based on history. Right now, it's the opposite. Valuations are relatively high based on history. They're not at all-time highs. They're not, again, the valuation, not the price. But the valuations are not at all-time highs, but they are relatively high. And so the best thing I think to do in that situation is to dollar cost average. So again, kind of given that example of $100,000, potentially that's $25,000 a month or $33,000 over 3 months, some way of spacing out your investment so that if the market does keep going higher, at least you're getting some of your money right away invested and you have an opportunity to kind of average in higher over time, and vice versa. If we are at a near-term high and markets do a little bit of a pullback, that'll give you the opportunity to get back in at a lower price. So right now we're at one of those times where I think dollar cost averaging makes a lot of sense.
Thanks, Chris. That's really helpful. I'll jump in with a follow-up question too. So if we anticipate the Fed cutting interest rates, another question I've gotten has been, how will the Fed funds rate and the cuts anticipated there affect things like mortgage rates? Do you see anticipated, rate drops before the cuts, in advance of it? Do you think that there will be, large pullbacks after? I know it's not an exact, chain of events, but from your experience and what your, opinion might be, that could be helpful to other folks that are either thinking about potentially refinancing or taking out a loan and trying to get an idea as to what the expected timeline might be.
Yeah, so I think, when it comes to the Fed cutting rates, which again is the overnight rate, you'll typically see that longer term rates, the kinds that are used in order to set mortgage rates, or the kind that you'll see across most types of debt, those will react instantaneously. So you're really seeing kind of mortgage rates, or you're seeing treasury rates or longer term rates. Those will adjust in advance of the Fed cutting rates. So to some extent, you've already seen a little bit of a loosening of policy, or a loosening of interest rates on the longer end. Clearly the short end won't move until the Fed actually moves. And really from there, it's just going to depend on how many times the Fed cuts rates. The shorter answer to your question is, to some extent, some of that's already priced in. But if the Fed starts to telegraph or indicate that they're going to have a longer or deeper rate cutting cycle than usual, then in the future, as the market starts to discount that, you'll see even further adjustments, and vice versa. If the Fed has, if the expectations are in the market for the Fed to cut 4 times, and instead people decide or get the feeling that the Fed's only going to cut 2 times, you could see things reset a little bit higher. So the answer is, it's a little bit already has happened, but more will happen in the future depending on kind of how the economy unfolds and how the Fed reacts to that. So a little bit of both.
Awesome. Thank you for that explanation. And doesn't look like anyone's unmuted their lines, which is fine, but maybe just want to make sure that you have the ability to do that. So at this point, since we haven't had any other questions, we'll wrap up. Certainly feel free to email myself or anyone on our team to do a follow-up. If there were questions that you didn't get to address, either because of technical difficulties or whatever, please shoot us an email. Or give us a phone call. We'll try to get back in touch. Thanks for joining us. If you are local, love to see you on Friday, 9 to 11. Otherwise, have a great rest of the week and a fun Labor Day weekend. Take care.
Bye, everyone.